Hello, in today's series, we will talk about the Singpost Saga. What really happened? Is the share price attractive? I've noticed many of you questioning whether Singpost presents a worthwhile investment, particularly after its high-profile scandal that happened recently. For those of you who may not know Singpost and what this saga is all about because you did not watch the news, let me share a little more detail with you in this episode. Hello everyone, welcome back to SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share with you more trading secrets and valuable insights. To stay updated and be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. So, what does Singpost do? The building in this photo is the former headquarters of Singpost. Today, it houses the luxurious Fullerton Hotel. Even today, visitors to the Fullerton Hotel can find remnants of Singapore's postal history within these walls. Founded in 1819 to handle mail services in early Singapore, Singpost has a long and rich history. It was formally incorporated as Singapore Post Limited in March 1992 and became Singapore's first designated public postal licensee. Singpost was subsequently listed on the main board of the Singapore Exchange on 13 May 2003. Singpost operates across three key business segments, particularly Post and Parcel. This core segment encompasses domestic and international mail and parcel delivery, along with postal services offered at post offices. Logistics. This segment focuses on freight forwarding and e-commerce logistics, including e-commerce solutions, warehousing, fulfillment, delivery, and other value-added services, primarily within the Asia-Pacific region. And lastly, property. This segment involves commercial property rental and a self-storage business. Recent financial results for the first half of 2024-2025 earnings indicate a decline of 5.1% in the postal and parcel segment, while logistics and property saw good improvements of 35.1% and 13.2% respectively. Total revenue increased 20% year on year. So, what really happened at Singpost? Singpost once enjoyed a dominant position as Singapore's sole postal licensee, with promising prospects in the early 2000s. This era saw the company attempt to capitalize on the burgeoning e-commerce sector, notably through a strategic partnership with Alibaba. This collaboration, aimed at expanding Alibaba's Southeast Asian presence via Lazada, initially boosted Singpost's share price significantly. However, Singpost's diversification efforts, including a substantial investment in the US logistics firm Jagged Peak, proved unsuccessful. The company faced significant losses as these investments faltered. Concurrently, Singpost's core mail business faced increasing pressure from the rise of digital communication and online advertising, leading to declining revenues. The logistics sector also witnessed heightened competition from emerging players like Ninja Van, Shopee Delivery, and J&T Express, who offered more competitive delivery rates. These confluence of factors, dwindling core business, failed diversification attempts, and intensifying competition eroded investor confidence and significantly impacted Singpost's share price. The company's declining fortunes may have contributed to the recent scandal that triggered a media storm and led to the departure of top management, including the CEO. Let's now look at the recent Parcelgate saga in a little more detail. What exactly happened? In early 2024, Singpost received a whistleblower report regarding its non-regulated international e-commerce logistics parcel business. A similar report was also submitted to the Infocomm Media Development Authority of Singapore. An investigation found that 3 managers, including the CEO, had severely violated the company's code of conduct. Specifically, they manipulated the delivery failure status code for parcels belonging to a major customer. This involved manually updating the status without proper documentation or any actual delivery attempts, likely to avoid penalties for failed deliveries. News of this misconduct was publicly released on December 23, 2024, causing Singpost's share price to plummet 10% in a single day. Investor confidence was shaken by the revelation of these serious breaches, and concerns arose about potential systemic failures within the company. It's important to note that this is not the first scandal to hit Singpost. Two other major scandals have occurred since 2005. To assess whether the current market reaction has overvalued the company, let's now examine Singpost's profitability and valuation metrics. Let's understand more about Singpost's current valuations. Singpost currently boasts a market capitalization of Singapore dollars 1.24 billion, reflecting a significant 50% share price decline over the past 5 years. This translates to a PE ratio of 15.9 times, a price to sales ratio of 0.67, and a price to book ratio of 0.88. While these valuations appear attractive, further due diligence is crucial to determine if the low prices justify an investment. Analyzing the recent cash flow statement reveals a positive picture. TTM operating cash flow has increased 23% year over year, while cash flows from investing and financing have grown 27% and 30% respectively. This translates to a 54% increase in free cash flow. However, the significant increase in investments raises concerns. While higher investments should ideally lead to improved returns, it's essential to monitor whether these investments are generating commensurate value. The Australian segment has been a key driver of these positive results. Singpost's acquisition of Freight Management Holdings and Border Express reflects its strategic focus on this region. With a payout ratio of 21.2%, Singpost still appears to have room for sustainable dividend payments. In conclusion, Singpost has recently faced significant uncertainty due to a corporate scandal. However, this creates an opportunity for potential undervaluation, especially considering its recent financial performance and strategic initiatives. Several factors support a positive long-term outlook: successful expansion in Australia and the growing e-commerce market. Using a discounted earnings model with a 2% long-term growth rate and a 6% expected return based on Singpost's latest weighted average cost of capital, I valued the company at 90 cents per share. At the latest closing price of 54 cents, this represents a 52% discount to my intrinsic value. This significant discount suggests a margin of safety for patient investors who believe in Singpost's long-term potential to execute its restructuring strategies with confidence. My analysis suggests closely monitoring Singpost's progress as its turnaround plan unfolds and e-commerce initiatives mature. Once the scandal subsides and new management is in place, the current share price may present an attractive entry point for investors who understand both the risk and rewards involved. Till then, goodbye and see you in my next video.